eyes the opportunity to take the business away from Yahoo Messenger.
Right.
And Yahoo itself was going down.
Right.
It wasn't supporting. Yahoo didn't realize the role it played in the oil business.
He doesn't really know. Yahoo and other messengers had the timestamps, but they didn't have it to the second. And you needed it to the second because that's how important it can be in oil trading for these price assessments. So that's why you use them.
Yes. And then ICE was willing to go to the millisecond. So stepped up the game.
Wow. Hi everyone, welcome to another episode of World of Oil Derivatives. Today is another episode in our Onyx Leadership series. Today I'm joined with Jorge Montepeque. Now Jorge is a legend in the industry for a number of reasons. I think it's worth quickly explaining to get the context. Everything Onyx does in its trading is trading oil swaps. Now really they're futures, that's an easier way to understand it. More niche futures than the classic Brent WTI. Now, we called them swaps because they did used to be traded just bilaterally. And when they were designed, it was Jorge Montepeque that designed the index and the indexes that are used to price those swaps. That became futures. So these days, the futures volumes have grown 10, 20 times over the past decade. They are now many more times the physical volumes. And there's more and more contracts starting every year. We're up to 700 plus listed on ICE Exchange alone. So Jorge really has been involved in not just the forming of these indexes, but how they are then priced and making adjustments to how they're priced in order to keep everything fair to the end user or to everyone in general, to maintain like good regulation and of course quality of data that is useful for many, many different organizations and corporations around the world. Jorge is joining as our managing director of benchmarking. And there's a lot of things he's here to do. We're not going to reveal all of them right now. But Jorge, I thought we'd start just to say thanks very much for joining. Thanks very much for being here. I'm really looking forward to this discussion because, as I say, everything we do at Onyx is essentially what you created, which is a very cool thing to be able to say and have the guy who's here. So thank you and welcome.
Well, thank you very much for having me here. I have been thinking about this opportunity, and we had some initial discussions where you were describing what Onyx is, what it does, and then, of course, having a history and a reputation of digging into things, I started to do that. And the more I dug in, the more interested I became, because Onyx is truly a treasure trove of data. In my opinion, as I reviewed what was happening here, is Onyx is the liquidity master in the derivatives world. And throughout that activity, it generates just bundles and bundles of data that then, of course, have a value to the marketplace. And another thing that impressed me very much about the company is the company has an ethos of being very transparent. And what Onyx knows, Onyx wants the world to know. Onyx doesn't make a living out of keeping data from its counterparts. It wants to share everything it has. I have never before saw that model in any other trading company. In fact, any trading company makes a living out of hiding stuff, right? They want to trade on proprietary data. You have none. You want to put it out. You want to publish it. You want the world to know. And that's a very attractive proposition.
So maybe we could start there then. When you started, and I actually don't know, and Platts, when was that when you started?
I started working in Platts in roughly, if memory serves right, 1988. A long time ago. So
that was the beginning of, I don't even think the WTI benchmark had been formed at that point.
It was in the process of being formed with the then NYMEX, not CME, having a hard time convincing the industry that it truly was a deliverable contract. And the whole industry was, of course, in a state where it couldn't believe it could be done.
So this is the very, very beginning, right? Yeah. So when I was writing my book, that was the first thing. You want to take it back to, the root and how everything started and like what even is a contract? What is this all about? And most people would say an oil future should be deliverable to physical oil. That's a very interesting point because it's turned out to not be anything like that, really, the bulk of derivative interest. But you're saying to begin with, that was how the market was taking it.
Yes, and I think that was the right approach. If I look back just from a purely intellectual point of view basis, if at the beginning of a market, you try to explain to folks all that you need is price convergence, but non-deliverable. The contract doesn't have any delivery whatsoever. It's just a paper. People won't get it, right? In those old days. But if you tell them you have a contract that you buy, and if you hold it to expiration, you get the oil barrel. And if you sell it, you have to deliver. They understand it.
But from the off, was it ever a viable way to buy WTI oil, the physical oil itself?
That's why NYMEX had such a hard time to convince people to use Cushing as the delivery point. It was really, really hard to understand. But they got through that hump, convinced the market, and then many people in the market understood that holding a physical contract is a very dangerous thing to do because you may end up with oil that you don't want.
Yeah. And where it's delivered, you might not have any way to access that, which is why wasn't LLS trying to be a contract at the same time?
Yes.
And that's a Gulf Coast crude that's much more accessible. How come that didn't work?
There is a great thing that happens in markets. Once you are attached to one, it's very difficult to unhitch yourself from it and switch to the other one because this has the liquidity. This has the open interest.
That's something that's so not well understood.
Yes.
But yeah, sorry. But go on.
So you can build another physical contract that is better in terms of the location, better in terms of the size. But if everybody has already an open interest, standing contracts based on the other one, you will use the inferior product just because it's bolted into the system.
But again, why was it WTI? So you're just saying the guys who were starting off in WTI just were married to the idea of having it in Cushing, and they couldn't let go of that?
At that historical point, the Gulf Coast was not what it is today with the ports for export. And
weren't allowed to export, right? Yeah.
Correct. It was a domestic market. It was all inside, and Cushing was the delivery point. So you define it as how it is. And when you create a contract, you don't invent something new. You take something the market is already doing, and then you modify it a little bit, and then you cement it. Once you get that going, then you can modify it further. But if you modify it too much from day one, there will be no empathy in the marketplace. And the empathy in people's activities is very critical. And at that point in time, there was original trading in Cushing. So it was natural for NYMEX to modify that concept a little bit to have a monthly contract.
And heating oil had already been trading, so people were already familiar of oil trading to some extent. WTI then did take off. So at that point, you started to get a lot of interest in futures. So I guess at this point at Platts, are you focusing on this, or was the job more about just reporting physical transactions around the world?
The job at the beginning, what I was doing was on reporting on the physical transactions, primarily international.
Okay.
Which was Dubai and Brent.
So to give people color to people in the US?
Globally.
Okay.
Because there are contracts that have a limited footprint. At that time, because the US didn't export any crude oil, the footprint of WTI was very limited, was all domestic. But a lot of crude was moving back and forth globally. And people were starting to use Brent and Dubai and Oman, which is no longer used, as the instruments that were reflecting value.
And at that point, it was only simply a data point, nothing tradable at that point.
Correct.
Just to understand. Okay.
And the trading companies would submit data, trying to convince you over the phone that, the value for dated Brent and Dubai and Oman is here or there. But felt a little thin, I would say, because there was nothing where people were standing behind the number. It was just a number.
So they were saying, I've heard it's traded here. I was bid this. I offered that. And then okay.
And then perhaps what I brought to the process is trying to bring some discipline to ensure that the data was supported by real activity.
So can I just before you go on, again, you used to mention about the attraction to Onyx being the transparency. So has it always been a driver for you to say, look, a fair market or transparency, or what is it that you were thinking even at the time at Platts?
Well, now that you put it that way, yes, there has been a consistency in thought.
Okay.
That a market requires the glare of transparency. And it's really a glare.
I also want to just quickly say, I can't help myself. But the other thing is, I've never known you personally until the last couple of months.
Yeah.
It's been great getting to know you. But I definitely knew your reputation. And you had a reputation for being stubborn and forthright and, basically a pain in the ass for traders. But that's obviously what was needed, because obviously they're trying to put their own agenda into these prices. You need someone to say, no, this is the way it's going to be. These are going to be the rules. And it's a formidable reputation, because to go up against the whole industry with all this money who are trying to influence things and standing firm, you've got to have an underlying philosophy of this is right versus wrong, like incorruptible.
Yeah. So you need that glare of transparency. And you also need a little bit of an understanding that people's positions change. So if I am misusing my trading position this time, call it 30 years ago, maybe the following day or week, my opponent will use the same technique on me. And then I would observe what this person said this time versus what it's saying the following week.
So you start to get a sense of how people would talk when they had bought oil, when they had sold it, basically.
Yes.
Yeah.
When they had an agenda.
Yeah.
And what were the instruments or the techniques they were using to further their agenda.
Understood.
And then to start to formulate the defenses against those agendas. And that, again, the first defense is transparency. Because you cannot hide really under a rock. When you're doing things out in the open, it's very difficult to hide your agenda. So what attracted me to Onyx was that there's transparency. So there is no big hump to get over in here, because it's already part of the company ethos, which is a great thing. And then it's about establishing the systems and publishing it further and having the discipline and consistency. Reliability is critical.
So at that point, you're saying WTI is now starting to get going. There's a futures concept. You say we need the transparency on these quotations. What was your first move to create that consistency and transparency in these physical transactions?
To start to request names of counterparts, and to start to request that people stood firm when they say somebody is buying at this price, which is, let's assume, is too high or looks high.
But how are you monitoring this market?
By phone. It was by phone at the time, but everything was done by phone.
So you would only use a transaction price in your assessments of the index if that transaction had been A, reported to you, and B, you knew who was counterparts on both trades.
Yes.
And that's how that started.
Yeah, that's how.
And would you say, if I don't care what's gone on, unless you tell me it's you and what the price was, that's the only way I'm going to put it in my assessment?
Yes. And then there was at some point I moved to Singapore, but the critical element really after the beginning of transparency was put into the marketplace was a recognition that price is a function of time. That maybe you did a transaction, maybe it is true, but the market has moved on since that time. And now we need to determine what is the new market value. And that results in people responding to that request and saying, I am firm to buy an additional barrel right now at this price. And if you want to tell anyone in the marketplace, do so, because I'm genuine in my desire to buy. And that leads to the next iteration in what I did for my former employer, that I want to have the system to broadcast
But
these
hang on,
bids and offers.
but was there not a step before that, which was the window?
Yes.
Yeah.
So the window was reflection of the recognition that price is a function of time. So we set up various timings to set the prices, and all of that has evolved numerous times since.
I'm just curious. I just love to know, because of putting yourself in your shoes back then. I imagine the iteration would have gone something like, I'm getting these reported transactions. I've told them they need to have their names, so they're real transactions. But now there's just too many, and as you said, it's a function of time. So one thing in the morning could be very different in the afternoon.
Yes.
So actually, Argus have maintained that. They take the weighted average over the day.
Yeah.
But you made the decision to say, nah, this isn't right. We have to have a localized point in time, and I want to use those transactions in those periods of time to get more. I guess, were you thinking a better, highly accurate number in a short space of time than a varied accuracy over the day? Was that kind of...
I will give you an analogy, taking it away from oil. The price of a stock price is a function of time. If you try to buy a share of Exxon right now is different from the price it will be in 5 hours. So if the price of a share is a function of time, you cannot tell an investor that the price of the share is what it was 5 hours ago.
Right.
You need to tell the investor the market right now is this value. Do you want to buy it or do you want to sell it? Because this is what it is right now. And what is the difference with a barrel of oil? It's the same thing. The historical price is true, is correct. Maybe it was, and I hope it was. But the price right now is different. Mm-hmm. Do you want to go long or do you want to go short at this price? Do you want some more? This is the price right now. And in order to do that, you need to have and create standards in timing when you're going to determine that price. The creation of the window was also a function of the recognition that liquidity in some markets is very thin. So in some markets, you may only have 1 or 3 transactions in a day. In some, you may have 10, but you don't have thousands, you don't have hundreds. So you need a localized time
where you encourage people to trade,
where the buyers and the sellers congregate.
Yeah.
And if you look historically, many of the marketplaces were like that, including cotton and all of this. It's a place where the buyers and the sellers agree to be in that place. They bring in metals and say, now we're going to determine the price. Now is when I will sell and you will buy.
So because my knowledge of this is I traded dated Brent, and the 4 to 4:30 window is exactly how you're describing it. It's a very poor one. Everyone kind of waits around for that moment in time.
Yes.
But it used to be 7 to 7:30 in the evening.
Yes.
And also, still to this day, the congregation of trades for paper, let alone just the physical, the derivatives, is all with PVM, the brokerage.
Yes.
So why did that happen?
Yes. So number one, you need a congregation, a time, and a place to meet. And the time has to be empathetic. So if you make it too late, you really disturb people's lives because they need to go and have dinner and go home and sleep at some point, right? So over time, we moved it from 7:30 to 7 to 6.
People used to trade, go to the pub at 4:30,
Yes.
mess around, have dinner, come back for the window.
Yeah, maybe a little buzzed,
Yeah.
but, which is not the best thing, right?
Exactly,
It wouldn't be possible
Yeah.
right now. So 4:30 makes sense. And it all still connects with New York and Houston. You cannot make it much earlier because then you disturb people's lives on the other side. So you want to find the most optimum place where you capture more geographies in that time. And then you need to determine a place where they will meet so the forces of supply and demand clash, because that's how price is generated, right? And then you can say this will be done electronically in eWindow.
No, you've jumped a step. So this is all still by phone, and it's great fun. Even today, you kind of leave your speakerphone on, and all the brokers at PVM are shouting at each other with their orders from their clients.
Yeah.
And it's open outcry, and it's like the LME4, like it's great.
Yeah.
And that was of course, very much the case at the time, 7 to 7:30. But well, I guess, not to be a tangent, but like, why was it PVM? They just were the only like established broker at that point, and you kind of made an agreement? Because I would make the argument that made their brokerage.
I think if you ask them, they
would agree. So you reached out to them?
No.
Okay.
There were a few, as we would call them at the time, pretenders to the throne.
Okay.
There were a few shops that were offering the service and that discovery process. But like in any business, there are some that are better than others. Some that maintain the people there ready to take the orders, who were willing to work the extra hours, who were willing just to do what they had to do so they would attract the flow. And PVM was the company that rose above the rest. And there is a natural tendency as well in people that if I have two marketplaces, I can have a price disparity, an arbitrage between one and the other. And then over time, I will migrate from the one that is less efficient to the one that is more efficient. And that means that one company will be the final winner. And PVM offer a good service. And then they broaden to put a little bit of advisory and give trade ideas and what the market is doing, some of the interesting things you're also doing. So when you step up the game, you tend to attract more and more of that liquidity.
So they chose themselves in a way. Everyone could have taken it, but it was obvious that the liquidity was congregating there.
Yeah.
And they said, okay, so we're going to take the sum of the transactions on the derivatives and the at the time, purely just physical transactions from the PVM transactions during this window time.
Yes.
And that, I imagine, it was just a big step. It worked very, very well, right? It was a routine for the market for a long time.
Yes.
But you weren't done, right? So we had you wanted a more efficient way. So I guess one of them was moving the time closer, 4:30.
Yes.
But it's the digital age and technology obviously coming in. So was this early 2000s?
Well, it went through several iterations, really. First, it was in the Singaporean market, and we were using messengers through the internet to submit the bids and the offers, while simultaneously also accepting
Yahoo Messenger. Again, I think, when I first started trading, I was using Yahoo Messenger, and I honestly think the oil trading community supported that business. It was just like millions of keystrokes a day at least,
Yes.
just on that chat. So when it migrated to Ice Chat, that was must have been a big loss for Yahoo, is what I'm saying. But
well, and that was a function of us having U-Window that gave us the opportunity to take the business away from Yahoo Messenger.
Right.
And Yahoo itself was going down.
Right.
It wasn't supporting. Yahoo didn't realize the role it played in the oil business.
He doesn't really know.
Didn't realize that at all.
But you were telling me, so I know this bit. So Yahoo and other messengers had the timestamps, but they didn't have it to the second, and
Yes.
you needed it to the second because that's how important it can be in oil trading for these price assessments. So that's why you use them.
Yes. And then ICE was willing to go to the millisecond. So stepped up the game.
Wow.
And this is how all these things work, is can I do it better and better and better? And then you just get the congregation.
Everything always gets more efficient. And I
Yes.
think this is a great line of discussion because I would argue some areas in oil trading just will not budge. And the better is not necessarily, it needs disruption, but it's not as simple as just saying what's better. It's what you're used to, like you said before.
Yeah, there is a natural tendency among people and systems to, the old system were better. I don't want to change my life. I don't want to do this and that. But over time, if you take enough time, you will see that things migrate to a more efficient system.
So you took that view, obviously you could see the technology booms, I guess, and you knew where it was going. You knew this would be the future.
I was very friendly to technology. I was very friendly to opening systems to communicate with our clients. So I started early systems that use text messaging to submit the numbers to the participants. In those times, the phones were not smart. So I was using plain texting to communicate with the
And
clients.
it's documented, so it's all there. The history's there.
Yes.
You can,
And now it's quite clear that faster is better, more transparent is better, easily accessible is better. So any system will naturally gravitate towards that area. And I facilitate it very strongly, and I urge people to move all the time into the more open systems. Because also you cannot stand behind, I'm going to do it slowly, I'm going to do it in the corner, just with this broker. It needs to be open, right?
And so the digital element came along, you needed some development of essentially this window becoming an e-window, so people could submit this directly online. Again, was it the same thing? You have SGX at the time still doing quite a lot on oil, CME and ICE, and how come the Platts e-window is now exclusively at ICE?
Those were very difficult decisions at the time, and because Platts was not a technology company, so it was clear that it needed to use an outsider to do the software development. I and my team had the requirements of what e-window needed to be, but we internally didn't have the capability to build it. And we explore with a couple of other vendors before we settled in with us. And we actually had a few runs with others, but those were early days in the internet era, and the other vendors had latency issues.
Right.
And I could not tolerate anything where something was a second delayed. And ICE delivered the better product. So
it made PVM and then it made ICE, because ultimately that's where a lot of the trading was happening for the price assessment. The price assessment is the most important time of the day for everyone in oil. So henceforth, it was logical that you're using ICE for Platts, then you're going to use it for other things as well. And so from the oil side, at least,
it
creates the congregation. So
yes.
It really is fascinating. On retrospect, you should have had shares in these companies when you did it. You helped.
But maybe there was a little bit of a conflict of interest or something.
Of course,
we were very critical at the time about that.
But just getting to a bit more like the macro. So price assessment in general. I mean, what is your view on, your objective is the truth. And you mentioned it very clear, it's the truth. And I like that. To find the truth, I'm just going to ask a random question. Like, is it almost a good thing to get people to try and game it? Because it's like giving your software that you've just developed to a tester. The idea is for them to do whatever they can to break it, so you can say, okay, let me fix that. And then over time, it becomes very robust. Obviously, you've never been a fan of people trying to game the oil price. I mean, there's ramifications for people around the whole world. But at the same time, if your index calculation methodology is not robust enough, then it's not really their fault, because they're obviously going to do what's in their best interest. How did you view that out of interest?
Yeah, you have to assume that a trader has a function, which is to make money on the trade. That is the truth, right? And if he's left to his own devices without any perimeter and discipline, he'll do many strange things to ensure that that contract becomes positive. And if I am mature on the side that I have to publish the truth, I have to accept that he will try to break it. And I have to think ahead of time, how can he break it? And you used terms that I was a pain with the traders, and yes, I was, because I was building the defenses in the system.
And you knew their game. You knew how to think like them.
I had to think like them. And if one of them could outthink me, maybe he could do something once, and I would monitor it, learn from it, and apply the. And
did that motivate you? Or did you enjoy that kind of cat and mouse type thing?
I have thought back. I cannot say I enjoyed it, but it was a cat and mouse thing, and those things can be fun, right? But they were so much time consuming.
But the service you've done to the industry, like, it just sounds like I'm being over the top, but it's not, because, I mean, even now, there's a few price assessors. It's easy to be lazy, because it's like, what do I really care? As long as I can prove to the IOSCO principles, the regulatory oversight from the EU, that I've done what I can to make them, generically robust, then what do I care? You have to really believe in what you're doing. Say, no, I know what you're doing, and I know it's not fair, and this is fair, and this is what I'm going to do. There's got to be an inherent driver there.
And also the issue of longevity, because you can build something that is good, but that it will break.
But was that pride for you just in your job, or pride for something you believed in? Or I'm just interested in that.
I just enjoy the concept of supply and demand, market forces. And I am a believer in free markets.
Free markets, okay.
Those two forces need to clash.
So what would your view be that, you've done your job and there's nothing really untoward, but ultimately the benchmark in question is overextending, it's getting a bit ridiculous, but look, it's bullish, let's say, and it's going higher. Like, how did you view that? We're like, well, look, it's doing its job. For example, WTI going negative. Like, what was your view on that at the time?
Clearly, and at the time, and I talked to many reporters at the time, clearly, oil is not negative.
Well, it did trade negative in the physical world.
It traded negative, but the reason it traded negative is because the contract was badly formed.
No, I'm saying there was physical transactions in domestic US that transacted negatively.
Nobody denies the facts.
Right.
It traded negative, but the fact that it traded negative was a function of the CME or NYMEX designing a contract that was faulty.
And what was the inherent fault? You should have just said zero is only ever going to settle at zero,
no,
and nothing less.
No. You cannot prevent market force.
Okay.
The market force at the time was there's more supply than the buyers can take, and therefore it needs to clear at a number that ultimately makes sense
encourages
for somebody to take it.
Yeah.
But what it means is that the delivery point was too narrow because it was cushioning. If the contract had been modified earlier to move it to the Gulf Coast, WTI would have never traded negative. So this is a contract design flaw.
I don't know if I 100% agree. I'll tell you why. Because the WTI didn't trade negative in settlement. It traded negative the day before. It bounced right back up because people could see its negative, thought that's a buy. They bought it all the way up. I think it settled like $7 or something. I can't remember. It settled a lot higher. So it did its job, the derivative market. It got low enough to encourage new buyers. If it settled there, I understand.
Yeah.
But as in, I think that was a consequence of supply and demand, exactly as you're saying. And if it should have gone negative, there was no one to buy negative. It's just no one believed it could.
But if the contract, in the history, I had a lot of meetings with the CME over the contract flaws that we needed to move it, to adapt it to the new market conditions, because Cushing doesn't have the ability to take all the crude that comes out, more so as new production was coming out, and the refineries were not being built around Cushing. The market buying power was being set in the Gulf Coast. Therefore, it was clear that the contract needed to be reset. But the CME was afraid of resetting the contract to the new market conditions. Likewise, Brent was having exactly the same but opposite issues. Instead of having too much supply, it didn't have enough supply. And at the time, I could have taken the point of view of just let it be. And if I had taken that point of view, somebody would have bought for sure Brent at $200 a barrel because there wasn't enough and the market needed 200 to clear. So you need to be responsible in formulating the contract so it reflects the broader market economics. So when CME-TI was trading negative, the oil market in general was not negative. It was that contract at that particular location.
Yeah.
And as a provider of value to the market, it failed.
I don't know. This is interesting because I'm thinking then just if you're aware of this trade, Brent, but if they provide alternatives, which they have done, they've provided a Houston contract for WTI and ICE. There's a Merben contract. There's loads and loads and loads of contracts for you to choose. People choose WTI because they know how to make money on it.
Yeah.
So even if even if people decide not to trade it as a hedge, it will still be traded because the infrastructure around Cushing and people's refinery systems and people's trading books and risk management is geared towards trading that contract, which by definition makes it like a kind of a robust contract. Because to your point,
makes it a tradable contract.
It does, but if there's money to be made, people. So your point about markets becoming things becoming more efficient.
Yes.
Then I know it sounds bad, but allow the dogs to ravish the body. Eventually, there won't be a body.
Yes.
So that's what's happening. So there's so many people trying to make money that, in an ironic way, they force it into something that works.
No, but they can't, because the contract has attributes that in the case of the CME are unchangeable. In the case of Brent, the attributes were changeable. To use the terminology of dogs ravaging a body. If the attributes of Brent had not been changed, they would have eaten anybody that goes in there.
The dogs have eaten the other dogs.
Non-stop.
Okay,
right?
so there's no limit to human greed, is what you're basically saying. Yeah.
So if you're the issuer of the standards, you have the responsibility to make sure that your standards reflect broader market conditions, because otherwise the contract cannot be used broadly. It will be seen as a contract to be used in that particular corner, because under certain circumstances it fails to reflect broader market economics. And let me add this, and the market has recognized this by using more Brent than WTI as a setter for international transactions, right?
Yes.
Because it cannot be trusted.
Yes. I think we won't do it on this podcast, but I just want to say it because it's like we're talking very generically, but there's a lot of technical work that's gone into your career and these changes. Brent was literally the Brent oil field. People changed that. It was traded in 600 kb cargoes, and that was the transactions that you used to set the Brent price that we know today. That became more derivatives and a combination of the physical transactions and the derivatives. You then included Forties, Osberg, Eckerfurst, Troll, always adding more oil fields. Then huge changes coming in with like the CIF contract was attempted, which basically means you could move oil from anywhere in the world technically, bring it back in. Whereas at the time it was all about what was delivered and what was organized to be delivered. And there'll be many more changes. So there's a lot of hugely technical things. Quality premium, getting the quality premiums to link. So you have all these oil fields in the North Sea, and you say, yeah, but they're all different types of grades. So we can't just take one transaction price, because it's always going to be lower than the rest of them. There's no point having the rest of them.
Lower or higher, as the case may be, right?
So introducing quality premiums, genius, right? And then you would make adjustments to those quality premiums based on weighted averages of the previous month. And there's just so much that went into it. I just wanted to make that point, because it wasn't like a finger in the air. There's a lot of detail. The CIF contract, though, quickly. What was your were you involved in that? You weren't there at the time. No, that was beyond you.
And I'll give you a little bit of history. I am a believer that crude oils reflect certain qualities, and yes, you can adjust through quality differentials, but they do reflect certain conditions in the geography where they are in. And Brent and the North Sea has been great because it's not subject to hurricanes like in the Gulf Coast. So the production and the trading can continue, but it suffers from the really depletion of the fields. So it needs help from other locations to embrace more. And then you always should think, what is the easiest and nearest crude to embrace in? And at that time, far back, the obvious crude that you should embrace in is Urals.
Russia.
Russia. But there is a little bit of a political issue.
Right.
Back then, which has grown into something really, really big right now.
Yeah.
So you cannot do what is the most logical thing to do. Mm-hmm. And then the next one is Nigeria or the Mediterranean. There's still a lot of things that you could use. But let's jump all the way across the ocean into taking WTI from the Gulf Coast. And in the way it is constructed, it brings in several issues regarding shipping, where the price of the oil is not just the price of the oil, but is subject to some caps and floors in the price of shipping. So it makes it a little bit
Many more dynamics.
Yeah, correct. That's a good way of putting it. Complicated.
Yeah. I mean, just trading it and looking at it, all the relationships between the Brent time spreads and physical deliverable contracts around Brent, it's all been shaken up.
Yes.
And it still hasn't found a homeostasis. It's still quite hard to understand the links of it all. But that will, as I say, the same logic, it will figure itself out, because somewhere someone's making money on a certain type of strategy that people grow to understand and realize over time.
Yes.
And then the market evolves. And I think it's a great way of, it's a great thing about being a trader. It's always different no matter what, particularly in oil. So moving on, I've got to ask you about the derivative side of things, which is obviously what Onyx specializes in. When you have this idea of, I will need to know the physical oil price as an end user, as an investor, as a politician, you want to know where is the physical transacting. So you say, okay, I'm going to pull transactions and that whole journey. Why was derivatives so important for the market truth? Like, where did that come from? Was it because a lot of people started to negotiate physical to the derivative?
Well, there are, I guess, two leaps of the imagination as to why derivatives started. Number one, the exchanges created a handful of successful contracts. WTI, heating oil, gasoline, but they're really a handful. Then when you have a physical transaction, because the physical transaction is not a mirror of the crude contract or of the heating oil contract, there will be a deviation in the price. They will never match. So your hedge is by definition always imperfect. Mm-hmm. Because heating oil will not meet the qualities of ULSD barge, say. Mm-hmm. They're different animals. There'll be a correlation, but there is not a physical, there is not a true convergence between the two. Mm-hmm. But then somebody thought, and I believe this started in Brent, if we have they would call it paper at the time, a paper transaction that mirrors 100% dated Brent, then, but has no delivery, then the hedge is 100% perfect. So if you create a derivative that prices against the instrument you're trying to hedge, mm-hmm. then by definition you have 100% full convergence. Mm-hmm. And I believe that started in the dated Brent market, mm-hmm. but then it just caught fire across the market, this contract for differences. And because then you can create any contract you want. You're not subject to the futures contracts, the TI, the heating oil, the gasoline. You can create one for low sulfur fuel oil, for high sulfur fuel oil, for jet fuel. You can create
in every
a
region
derivative of anything you want, and you will have 100% convergence. Then all you need to worry about is, since I am delivering to you in that location, what premium do I need to charge you to deliver to you in that location?
So it's never 100% because of the physical differential.
Yes.
But still closer.
But the base is always full match.
Yeah.
And so that led to the original growth of derivatives, which had been already used and invented for a long time in the banking system for various other things. And then the second fillip in the market came in through the creation of accounting standards that came in under FASB 133. In the banking side, entities were long and short. Let's assume we're a bank. You're long, I'm short. And we are individually marking our books. And somehow you declare that in your books you have a profit, and I also declare that I have a profit, even though we have the opposite position. And this has caused a few problems in the banking system, because obviously it makes no sense. So
Enron types, yeah.
Yes. So you should never mark your own book. Somebody else needs to do it. And as these mishaps happen, the accounting standards came up with the concept that the derivatives needed to be marked independently by an independent body. So we, both banks, would use essentially the same purveyor of pricing for our derivatives. So you would have a loss and I would have a gain, or you would have a gain and I would have the loss. So the system was not gain anymore. And that created the demand for the benchmarks by the publishers, which can be Platts, can be Argus, can be whoever. And there have been subsequent accounting standard upgrades to the issues, but the need remains. And this is one thing that interests me very much about Onyx, because Onyx plays such a role in being the liquidity master. Then it really knows where these derivatives are trading. And therefore, this data is really precise as to what the value of a derivative is. Because right now, for a Platts or an Argus or any other publisher, they need to talk to a broker or a trader or maybe something online and find out, but the process is not highly disciplined and it's spotty at best.
And let's go over this one more time, because the world needs to understand, and some obviously do, there is no such thing as a physical oil price in absolutism, right? It's a derivative price plus a physical differential that gets you to the final physical oil price. It just doesn't exist. There's no outright independent physical oil market. It would be arbitraged against the world's oil prices, because everything is ultimately priced off Brent crude futures in some way or shape or form, and it's differentials that get you there. And then finally, it's the physical differential, which is a tiny, tiny part sometimes of the final price. So to have a well-functioning derivative market these days means a well-functioning end-user physical market, and that is a fact. So everyone is impacted in derivatives, whether they know it or not. So that leads us to the point about, you love to call it the Trinity.
The Trinity of pricing.
So the Trinity of prices is the modern thing.
Yes. In theory, one could have flat price in crude oil or in any kind of commodity, but it's a dangerous activity to do, right? Why do you want to sell a whole big cargo at $80 when in the next minute maybe $80.25? So you want to sell it differential related. And the whole market operates on differentials. So in the Trinity of pricing, you have the flat price, which is an equation. The flat price is a function of the underlying derivative plus or minus the physical differential. And that is the way the market works across any commodity, be it crude oil, be it products, be it in Europe, Asia, or the Americas. That's just how it works. And the interesting part for Onyx is that Onyx sweet spot is in that derivative part. And as it happens, the flat price being a function of the premium and the underlying, the premium is no more than 5% of the total price. So the price is primarily formed by the derivative. And any deviation in that derivative has a oversized impact
huge
into the flat price. So what I would like to see is more transparency in that derivative
price formation
and the marking of what the value is at the critical times,
which you think is still highly inefficient.
I think is the poor cousin, because the effort of anyone is in determining what the premium is, and then you just kind of take in the underlying. And I think that's where we can serve the market, we can serve the publishers, we can serve the exchanges, we can serve the market as a whole.
It's the next new improvement iteration. That's the
Correct.
essence of this story that you've been on. And that's why I love this conversation. I love you being here, because I've jumped I've jumped so deep into everything from how this was formed all the way to what it is today, and I just find it so fascinating. But I know by definition of like what I've been studying that it keeps going and it keeps going and it keeps improving, and we're trying to look a few stages further, and it's great to be part of this journey, and I'm really happy you're part of it too. I think we'll leave it there. because
Okay,
that was great.
Yeah.
And thanks so much for your time. And I'm sure you'll be back for more discussions at some point.
Yes. And I think the market should be looking forward what we're going to come up with. But as an early plan is to give the market several time cuts of the day of where those derivative values are. So it's very useful.
Great, thank you. And listeners out there, I really hope you enjoyed it as much as I did. That is the man who created the oil price, we'll call it. And we'll be back for more podcasts, more market episodes. So be sure to tune in, subscribe, like, and see you again soon. Thanks.